just received some juicy, fat dividend checks that I did not hesitate to reinvest into this market, baby. I live for market environments like this. In fact, I made most of my massive fat stacks during periods like the pandemic and other periods of extreme volatility, because that's when the real window opens up. Because the fear and greed index right now is sitting at extreme fear, and this is largely driven by the continued talks of tariffs, the effects that have on global spending into certain economies, the recession that could follow if it hits GDP, inflation. There's so much of this uncertainty that investors would rather sideline, but realizing as a long-term investor that sidelining just opens up that window where I can get better deals on stocks that I love. And I want to talk about the stocks that I invested in, with my favorite saying being cost average into the many and focus on the few. And I want to talk about the few I'm focused on while I also cost average into the many, because look at the volatility index. I mean, since the tariff war really heated up, the volatility has been all over the place, and we've been experiencing it since the beginning of this week. I remember Monday, holy crap, the market tanked, opened up extremely red, and a lot of stocks recovered by the close. And now we're kind of sitting flat into Tuesday here. But one stock that is driving the market before we look at my portfolio, kind of mind-blowing, is Newsmax. This kind of old school, conservative right-wing television show that loses millions of dollars is up over 1,000%. It IPO'd at $10 today and ran up to a price of $215, now consolidating, and this is their website. They didn't even turn up the resolution on Photoshop when they made their little clickables at the top of their website. Like, it is a garbage news company. Let's be real. Newsmax stock surged. So let's just read into this a little bit, because this week's IPO has been a monumental success for the pro-Trump Talk news channel, which has long been and also ran in the sector dominated by Fox News. Newsmax CEO Chris Rudy, who is now a billionaire on paper thanks to the stock's explosive performance, told CNN last election Americans voted against the media establishment, and similarly, investors voted by enormously buying Newsmax stock to say they like us, they value us, and they want us to grow. Something tells me that's not the case. Newsmax suddenly has a lot of capital to expand, but the market's overexuberance has some media outlets calling this a meme stock. Literally move out of the way, GME and BlackBerry and all that, because basically investors have plenty of reasons to exercise caution. The cable news landscape doesn't exactly scream growth. Newsmax financials are dreadful, and the company faces big legal challenges around the corner. Newsmax was motivated to raise money through an IPO, partly due to the defamation lawsuit against the channels stemming from the 2020 election, which had a lot to do with basically falsifying news and stirring a lot of hate toward the voting and the election and how that all works in the United States. And Fox had to pay almost $1 billion fine. I mean, it led to that guy got laid off. Some of the head reporters were laid off for really pushing that narrative as well. A lot of craziness going on there, right? But if you look, the company lost $72 million in 2024. Crazy this is? This is literal, it's still a defining moment that we are living in a very valued market. It's still a frothy market, in my opinion. It's not like 2022 where the correction really took place in crypto and all that stuff. We had a president pumping a meme coin and releasing criminals across the board for doing financial. Well, I guess it's not really fraud anymore, is it, to lie to shareholders and overpump stocks and promise a future that you can't really deliver on? But then again, if Elon's been getting away for this long, we might as well let, a lot of these people out of prison, whether it be Sam Bankman, who's been going on his little trailblaze as of recently from prison. I think about so many financial frauds that have gone to prison, and it's crazy some of them are getting out. But if we look at my portfolio and we kind of shift from the stocks of the day to what I'm doing with my personal portfolio here, folks, we got some fat dividend checks, baby. I took out $1,500 I got from SCHD. The S&P finally paid out. XEQT paid me a small dividend. Total dividends received year to date, $1,977. Not all that bad for a total yield of 2%. And I want to break this down because my portfolio has been down about 2.6% on the back of the S&P being down about 4.8. So it's nice to see the performance, stabilizing my portfolio in periods of volatility. But what I find most intriguing, the stocks that are hitting my portfolio the hardest are actually the biggest investments that I hold, not even the small caps. Obviously Aduro is a company I like that I'm holding here, and it's down only 16.59%. In fact, over the last month, I started working with a company called Orco Resources. They've sponsored my channel, and they own literally one of the largest deposits of copper globally based in Mexico. They've gotten the government starting to back them, and their stock's been going parabolic. It's up like 80% just in the last month. Now, they do have the tailwind of copper prices going up, but look at Google. How is Google down 24% this year from peak to trough? It is the worst performer, even against my small cap companies, which kind of blows my mind a little bit because this isn't a small company. I mean, can I just show you the metrics here? So yeah, I did buy Google today. Let's just put that out on the table. I couldn't help myself. I told myself I wouldn't, but when I look at the comparable size of the wife and I's Google position versus my Take-Two position, like I've loaded the boat on Take-Two Interactive, and I'm like, Google though, whew, baby, this is a no-brainer. I mean, we're talking about a media giant. I mean, we're talking about the new age of social media with YouTube, the fact that Google is not dying, the fact they're still a leader in AI and self-driving and all this stuff that I repeat like a dead horse, like beating it like a dead horse. That's even a saying that still exists. But I mean, look at the revenue growth here. Talking about double-digit revenue growth, very consistent. It doesn't matter what metric I look at. My typical metrics are if you have revenue growing, you have earnings per share growing, and you have a company that's buying back its shares here. Sorry, they got earnings per share growth and buying back shares. You're talking about a formula for success, especially a company that trades at a 20 times multiple that has double-digit growth. I mean, their earnings per share, have been exploding on the back of them increasing their gross profit. I mean, look at their profit. It's been growing double digits as well. If you take a look at the actual margins, their profit margins have started to expand for the first time since the pandemic. Everything is going in the right direction with this company, yet it is absolutely tanking. I think it's hilarious. I think it's a clear buy. I might be horribly wrong. Maybe insiders are selling or something. I don't know what's going on here. But even with the lawsuit coming up this month for the monopolistic fines, could not nearly be as detrimental as what's already priced into the stock. This is just my humble opinion. And I can say the same thing about Meta. I really feel like these are the platforms that every business is now building a base on. Everybody is socializing through. This is the nuance of society, and people just do not appreciate them. They get the lowest multiples against companies like Nvidia, Tesla, all these other companies. Yet regardless of the fluctuations of ad spend, you're still going to be spending all your time on YouTube, on TikTok, on Meta's platforms. And Meta's down again, like from peak to trough this year, 21%. It's down more than Aduro is, which is crazy to me. Not saying that Aduro should be down more. It just feels like we're in a very volatile market where people's ability to take on risk assets seems to be stronger than actually holding foundational companies. And Meta, same deal, checks all those boxes. You got a company here with, crazy margins that have been starting to expand a little bit quarter over quarter. I mean, if we take a look at, everything here, let's go back to revenue and profit real quick. If we take a look at shares outstanding, they're buying shares back, not as much as Google, mind you. Gross profit going up quite nicely, net income, earnings per share, everything going in the right direction. In fact, in ways that most Mag 7 companies can't even come close to, for that matter. So I'm thinking about even buying more Meta here because it used to be the largest tech company in our portfolios, and now it's actually become one of the smaller ones just because it's down several $1,000s in my wife's account. But again, we expect volatility. This is why we focus on a few companies. So when they go through these periods of volatility, it doesn't really affect the entirety of our portfolio because we have about 20% of our combined portfolios in individual stocks, probably less than that right now, just because we still cost average into a lot of index funds, which we'll talk about. But I really recommend, if you don't like Facebook, and a lot of people were hating on this, and I don't know why they said it was awkward. I thought it was amazing watching Mr. Beast and Mark Zuckerberg kind of talk about the future of Meta, because when it comes to Facebook specifically, he wants to figure out how to get more people on Facebook because apparently they have better ad sharing, like revenue sharing with people that make videos and put all that stuff. And Mr. Beast was giving them tidbits on multi-language capabilities for global audiences.
Like once it clicks in your head and you're like, whoa, only like 15-20% of the world, or whatever the number is, consumes content in English. And if you're not dubbing, you literally can't reach, majority of the world. It's like brutal. It feels almost barbaric to use a platform where you have to like pick a language. You know what I mean?
Our team is, especially on the Facebook side now, is really prioritizing building out all the tools that creators need to make Facebook their primary home.
Yeah, the auto dubbing I think will be it. We actually, in one of our 16 languages, we swapped out the voice actors and started doing AI dubbing, and the retention's actually 1% higher in that language, because when you do AI dubs, you can use my voice instead of it sounding like a voice actor. It's me speaking. So even though it's like marginally worse, because it sounds like me, people are watching a little longer, and it's getting so much better every month that I wouldn't be surprised if ideally in a year I just post a video on Facebook, check a box, and then it like you said, just AI dubs it in 20 languages. That'd be ideal.
But I love this company with a passion. So you can go check this out. Mr. Beast crashed our Mark Zuckerberg interview. Really, really intriguing Colin and Samir interview. And I want to talk about another interview that's really intriguing as well. But SCHD surprisingly has been the best performer of all my indexes this year, which is quite a shock because this was the lagger of the bunch. And again, in a volatile market where people run to safety, it's no surprise that SCHD is doing better. But again, I'm perplexed on this balance of extreme greed, this extreme, these gamblers that are chasing these stocks to propel it to them to insane multi-billion-dollar highs, and even in crypto still. Yet a lot of these investors are also running the SCHD, but they're selling foundational companies. I mean, even XEQT on a global basis is flat for the year and underperforming SCHD, but because that global exposure is in here, it's still holding up much better than the S&P, which is why I bought more XEQT with the SCHD dividend, because again, it's a small position right now in total. I think the wife and I maybe have like 10,000 plus in this ETF, but this is going to be where a lot of new capital starts allocating itself toward, because again, I'm not looking to sell off my S&P or any of these other stocks. In fact, I'm still buying the S&P, but once I get closer to my 35-year-old, 40-year-old self, right now I'm 32, as I scale into my age of, wealth preservation, and I've made it at this point, right? Like I don't need to take on exuberated risk. I can comfortably live off a healthy 8 to 10% return, even with our portfolios now. I'd rather, again, start to diversify a bit here. I did buy some more VDY this week as well. Again, keeping on the idea that I want to get about 100,000 in this ETF at some point over time. So I did buy a bit more VDY. But finally, like I said, I'm really waiting for the day that I can sell this. And I'm starting to think that this might be a longer hold in my portfolio than I initially anticipated. It depends on how much growth I get out of it and how much profit I'm willing to take. But the more I learn about the gaming space, especially after listening to this recent interview, which was really good with the CEO of Take-Two Interactive.
Give us a sense of Grand Theft Auto 5 versus 6. It's been 12 years now. Seems like a long time. Why does it take that long to come up with 6?
Well, there are really two reasons. The first is we set an intention actually to rest our intellectual property. So some of our competitors come to market very regularly, maybe even annually, with their titles. We only annualize our sports entertainment titles. For our non-sports titles, we think you need to create enormous anticipation on the one hand. And of course, on the other hand, it takes a long time to develop these big, robust experiences. Rockstar Games seeks perfection in what they do. And the perfection's a pretty high bar. It takes a long time. And the reflection of that approach is in the success of Grand Theft Auto 5, which has actually excelled in 3 console generations, which is extraordinary. And today, it's still the standard bearer for the industry, even though it was launched so many years ago. And that's kind of astonishing in a business where the technology is continuing to change at a pretty steep rate. So think of the high bar that creates, for us, of course, but much more so for the consumer.
He really hit home a lot of things that make me think I don't need to sell this within just the year. I think we could even let Grand Theft Auto 6 bake into the market for a while. And this company has so much opportunity ahead of it that I still think it is well deserving of double the market cap that it has today. And I might even hold on to it as a longer term play because I just like the space so damn much. But for now, like I said, I'm always just kind of playing this by ear and just kind of feeling it out as time goes on. But yeah, I'm fascinated by the market we're in and how perplexing it truly is with the volatility of everything from safer indexes to extreme gambling like companies. And I'm just sitting here holding tight, riding the volatility. Sometimes it's just better to turn your computer screen off and not look at some of this stuff. But I'm noticing a lot of people in my chat groups and my comment section are starting to reallocate their capital, because what I find ends up happening is in moments like this, people wake up to realizing that, oh, maybe I shouldn't have bought all these tech companies. I'm seeing comments of people that over leveraged in tech and now are a little bit fearful of the volatility that they're experiencing, because that's what happens. I mean, if you want high returns, you have to get high volatility, right? And a lot of people are saying, oh, maybe that wasn't the best idea for them. Now, I'm somebody that has been doing this for a decade, and I have found my balance at this point. So these periods of volatility don't really bother me all that much. But again, we're also looking at my portfolio that isn't down as much as the S&P, and I'd be comfortable experiencing a 20% drop. I mean, I always imagine that we'd have a black swan at some point where my portfolio could correct as much as 20 or 30%, or maybe even more. And if you are not ready for that at any point, at any time, you have to understand the investments you're making and where you're allocating your money to stomach those kind of markets, because there is one coming. I don't know when it's coming, but I promise you it's coming. So let me know what you think in that comment section below.